Don't all cringe at once, but it's banking season. The big five FTSE 100 banks are all due to report fourth quarter and full year earnings in the week ahead. In order, we kick off with HSBC on Tuesday the 21st, then it's Lloyds on the 22nd, Barclays on the 23rd, and to round the week off, RBS and Standard Chartered on Friday the 24th. Now luckily, it's a relatively quiet week for macro news because another 14 FTSE 100 firms are also due to report results, including miners Anglo American and BHP Billiton, house builder Barratt, media players Relx and Pearson, defence giant BAE Systems, and insurers RSA and Standard Life. But for me, the one name really capable of causing a fuss is Lloyds, due to release its fourth quarter and full year figures on Wednesday the 22nd. It's just over a year since then Chancellor of the Exchequer George Osborne scrapped plans for a huge sale of government-owned shares in the bank to you, the great investing public, citing market volatility when the stock was trading in the mid-60s. As we can see here, Lloyds actually bottomed out just below 50p in the wake of the UK referendum vote, but has since rallied nicely. Those gains to around 65p have been made even while the government's been selling stock to institutional investors in decent-sized blocks. Its stake's now gone below 5%, so the government, and therefore we taxpayers, are no longer the largest shareholder in Lloyds. I believe that honour now rests with institutional investor BlackRock. Touch wood, that in itself is a sign the bank's on its way to a full recovery after its experiences during the Great Financial Crisis, and the full year 2016 numbers are boss Antonio Horta Othario's latest chance to show further progress. Now at a headline level, there are two key numbers to watch. The first is pre-tax income. That came to 1.6 billion in 2015, but underlying profit was 8 billion once you include some really bad stuff, including 4 billion of PPI compensation, 837 million pounds of other conduct provisions, and 170 million of restructuring charges. The bank also swallowed 568 million of bad loan write-offs. This time around, analysts are looking for pre-tax profit of 6.4 billion, but you should look to see what PPI and other conduct charges, restructuring costs and loan impairments come to within that figure. This chart here shows their combined impact on profit by quarter since 2013. The total is nearly £22 billion. If Lloyds can keep its nose clean and cut down on those costs and cash outflows, it really could be a healthily profitable bank. The second key figure is the dividend. Lloyds increased its interim payout from 0.5 to 0.85p. It's expected to hit the final up to twopence, taking the total to 2.85, enough for a historic yield of 4.3% on that 65p share price. Watch for any comment on the 2017 payout and special dividend talk. Again, if the bank can keep out of trouble, the dividend could grow quickly and the yield may then really get income seekers interested. The consensus dividend forecast for 2017 is about 3.5p and a yield above 5%. In cash terms, that's about 900 million quid. So again, that shows the importance of cutting down on the compensation, conduct provisions and loan impairments. The next chart shows the dividend history over the last 10 years. The peak payout was 35.9p in 2007. Besides these key numbers, watch the trend in risk-weighted assets, 222 billion at the end of the last quarter, and note how the bank has been shrinking its way back to profit. Then look at customer deposits, which grew 1.4% year on year in Q3, a welcome contrast to the falls of 2015. More of the same could be a good sign, as it would suggest customers are regaining faith in the bank, and the deposits can in theory be loaned out for extra profit. And here's the quarterly deposits trend back to 2013. And finally, look at loan growth. Loans grew year on year in Q1, Q2 and Q3, albeit by less than 1% on each occasion. If this accelerates, the bank may be feeling more confident and maybe the UK economy would benefit too. Thank you for watching and I look forward to seeing you next time.